All right. Hello, you trader nerds. Welcome into a terrific Thursday. Real traders never trade alone. They trade with their fellow nerds. We got Schwaz in here. We got DB. We got Dunn. We got Edwin. We got Hal, who I missed yesterday. We got iPhone. We got Jim B. We got John D. We got Marty K. We got Matt Jolly Wally, who I missed yesterday too. We got Mo. We got Ricardo. We got Sam. We got Vicky with a Y. And we have Victor. And good to have all of you. Hope you're having a wonderful, wonderful day. So yesterday I was doing a little research and basically trying to figure out, what we're doing now with the TQQQ is we are basically timing the market. It really is a timing the market strategy. And I found this really neat little article. It's on philosophical.economics.com. And here's the link if anybody would like to go to it, but it basically came up with a better method. Now, of course, this is back testing, and we know all of this, but basically, this guy was using the same thing that we do, the 10-month moving average, and he implemented some different things in here as well. So basically, he used several signals to decide whether it was risk on or risk off. He looked at real retail sales growth year over year. If that was positive, industrial production growth year over year is positive. If real S&P 500 EPS growth year over year was positive, and if employment growth was year over year positive, and real personal income growth was year over year positive, and housing start growth year over year was positive, if all of these six things were positive, he basically was risk on and was basically 100% into the risk on asset, which would be, in our case, would be 100% TQQQ. Now, what was interesting is if any one of the six were negative, and then he would say, okay, don't consider this as fully risk on, then he would look at his growth signal. He would look at the 10-month moving average, which weirdly enough is one of the things that we look at as whether to go. So he would then look at that to say whether he's going long or staying long for the next month. So if price is below the 10-month moving average, he would say sell or stay out for the next month. So in other words, he would take this, and if all of these were positive, all of these not technical, but economic indicators were positive, he didn't even look at the 10-month moving average. He basically said, we are in a risk on position. This is not recessionary. But if any of these were negative, which might indicate recessionary, he basically then went to the 10-month signal. So I don't know. We don't want to necessarily complicate that, which should be simple. But what he showed is in the back testing that this really was strong, right? He showed that this really, really outperformed buy and hold. So I think what I'm going to do is see if I can get these data from 2010 on, right? The industrial production index. So it's really easy to see. It's either above or it's below. And see if I can get these figures on a monthly basis and then run it through our AI to see if indeed it improves upon what we're doing. So that would only mean that we would need to look at these six things once a month. So you're only looking at this once a month, but it'll be interesting to see if we could even enhance because here's the problem. The problem is 2022. And in 2022 is where we got into problems with the strategy. And 2022 was a little bit precarious. And it would be interesting to know if this kind of, I don't know, it may not help at all, but I thought it would be neat to play with and find. So if I have some time today, I'm going to see if I can run some of these numbers and feed it into the AI and see if it helps at all on our timing model, because that's what we're doing is basically timing the market. Speaking of the market, the NASDAQ is up 19.75 points, up 0.10%. And the E-mini S&Ps are down just a little bit, but everything appears to be going upward. Now, this is amazing. Look, you see divergence here. You see that the AD is flat and the ES is up. So this is kind of interesting to see this divergence, and probably what that means is that ES will go down a little bit farther to match what the AD has done. A lot of times you don't see divergence in this, but this is clearly divergence in this area. We were going down here slightly as this was going up. So you'll see these two normalize in some point. VIX is at 20. AD is at negative 126, which means I think this will be a little bit farther down than what we are now by the end of the day, unless the AD changes. But the AD low was negative 228. AD high was negative 68. All right, let's look at the big green monster. We'll look at NASDAQ first. And in NASDAQ, we are overbought, and we are about to hit a little bit of resistance here at the 25.17.5. And that should probably bounce off. And we would think at some point with NASDAQ being overbought that we might see a little pullback, at least to here, to the point of control in the next few days. That's because this is kind of a bearish little chart on NASDAQ. Let's look at the E-mini S&P 500 where things were fairly priced. And we're still fairly priced, and looks like we're headed up to the 58.67 before we see maybe a little pullback on that point. Or at least a little bit of resistance here as it interplays with that area. But we are fully priced, fairly priced on the E-mini S&Ps. Let's go to the linear regression and see what it looks like. See if we've got we still don't have what we would consider a breakout yet. It's close. It's wanting to break out. And if we get a nice big old day pumping this out, then I would say it is anchors away, boy. We will be headed up to the top of the channel. But as it is now, we are still making that decision. I need to actually move this out just a little bit until we can find our breakout. Let's move this one out a little bit. This has been an extended time of consolidation, which means we'll probably get some really big moves since it's consolidated for so long. This is winding up like a spring, and then whoosh, it's going to pop. So we're still waiting on that little pop. Now, I wanted to show you something on my little thing here. We fixed the hedge yesterday, but it looks like I'm paying some margin interest. So let's see that. Let's see in this account balance. Look at this. Pending margin interest, 75 cents. So we've got negative $353 here. So probably what I need to do is to unload some bill. How much is bill going for? At least unload $400 worth of bill. So let's see. Bill. Where is bill? Bill. Oh, wait, now let me type in bill. I want it. Let me type in anything. Well, let me do it. Stocks, ETFs. It's my, hold on a second.
Something on your keyboard, Bobby?
That's what I was wondering, Ed. Hey, Ed, I didn't know you was in here. Let's see if my keyboard.
Yeah. Hey, I just snuck in.
No, my keyboard's working, Ed. Look, but my thing is.
Just go to your positions and click on Bill, and it'll switch it over.
There you go. See how I missed you yesterday. There we go. There was Bill. So Bill's going for what? $91 a share. So what do you think, Ed? I get rid of about 4 or 5 shares of Bill.
Yeah. What are you short?
Look, my cash balance is saying I'm paying margin interest. Let me show you.
Yeah, but your negative cash is how much? 300 and something?
353. So what?
Yeah,
4 or 5 shares.
Yeah, I'd sell 5. You'll have an extra 100.
Yeah,
you could even sell 10 and give yourself a cushion if you want to.
Let's do that, Ed. Look at this. Ed and Hal's here together. Everybody's doing good. Yeah, let's sell 10 of those. Just to get rid of. There we go. Now let's see if our little cash balance. So y'all just need to check on that every now and then, y'all. Check on your balance there. And that should update at some point. So my big cash is up there, 1282 now. So this will probably, I guess it takes them a while to update this. Well, it's not settled. It's got to settle, right? So
yeah,
we just don't want to be paying margin interest. But this was kind of cool because if y'all remember the other day, it didn't say anything about any margin interest here. So check on this every now and then for those of us that are running a certain amount of bill. and make sure that, that this is something.
It didn't cost you much, Bobby. It didn't even cost you a Happy Meal.
Yeah, it didn't even hey, I went to McDonald's today, by the way, and I was going to try they have a chicken Big Mac now. Did y'all know that? A chicken Big Mac. I had a quarter pounder. I got it for free because I have so many points on their out. And then I got me a Diet Coke to set it off with no onions because I don't like the onions on the quarter pounder. I like the little bitty sliced, little diced onions, the dehydrated onions on the regular hamburger. But no. So we just don't want to be paying margin interest, y'all, is the thing. So, Ed, we hadn't got your opinion on what we're doing, Ed. Ed, listen, this is going to be blasphemy from what I'm going to say, but I have come to the conclusion that I don't think that you can outperform the market with an option strategy.
Well, I'm not trying to.
You're
So
not trying
I'm not
to.
gonna I'm not gonna argue with you on that at all, but that's not the common thread.
But does that sound like blasphemy coming from me that I don't think that we can outperform the market? I mean, you could probably get market returns with option strategy. I just don't think you can outperform it. Based on the August 5th thing, I think it was pretty rough.
Yeah. You can do it for a while, but there's always a gotcha.
Yeah, it's going to catch you up sometime. Here, okay, Sam wanted that link. Let me get it here. Here you go, Sam. See if you see it now. On this philosophical economics. Now, y'all, he's got a lot of stuff to read. So I'm just telling you this on this growth thing here, it's a lot of reading. But at the end of the day, basically, this is Ed's type stuff right here, Ed. This is stuff that you would look at. But Ed, I don't understand what this means. Real S&P 500 EPS growth year over year modeled on a total return basis. I don't understand exactly where he's saying to get this information.
I'll have to look at it, Bobby, but real means inflation adjusted.
Yeah.
So I don't know. I'll have to go take a peek. I'm going to click this link and go look at it, but thank you.
Yeah, look at it, Ed, and tell me, I just want to make sure that I'm able to get the data, because if I have a signal that's going to help me, and I just need to make sure that I can pull this data up. And what I'm going to do is try to pull this up today and see if we can add it. Ed, look at I think you'll like what we saw, Ed, but this is all back tested though. But basically, if we're using these particular signals, you can take this TQQQ thing from 2010 to present, Ed, and it takes $100,000 account to $28 million just on these signals.
Wow.
Yeah, which is good, right? And so if you had just owned 100% TQQQ from 2010 on, it would take you to about $6.8 million. So it really, really outperformed the market. And what we've done, Ed, is come up through AI, basically using a 10-month simple moving average and a 10 and 20 week exponential moving average. And AI helped me to optimize this to tell us what the ultimate adjustments were. Oh, we also put a VIX adjustment. TQQQ does really not good when VIX is high. And so what we also did is said we recorded the VIX for each month from 2010 to present. And if VIX, like here, was 22, it told you to get out of TQQQ by 7.5%. And when VIX was over 32, to minimize your allocation by 15 percentage points in TQQQ. So basically, it tells you the formula that we've come up with through AI is it tells you the percentage that you should be in TQQQ and then the percentage that you should be into TMF. And then we run those monthly returns out, and it did great in back testing. Now, I know this is back testing, and it's back fitting and overfitting and curve fitting and all the things that back tests are limited by. But at the same time, it gives you a little hope that in the future, I mean, and two, y'all got to figure out is technology, which is what we're basically investing in here with this TQQQ, is it going to continue to be bullish? And I think it is. I think we are in an environment where technology stocks, the NVIDIAs and those names are going to be, I think we're just at the beginning of a super bull market and those things. So we're willing at least to try it with about $76,000.
So Bobby, you've rebuilt your spreadsheet to signal all this?
Yeah, actually, Ed, what's this? What we've done is instead of a spreadsheet this time, we've got a allocation prompt. So basically what you do is you copy this and you post it into the AI, and then you give it this information, like you say, hey, my portfolio is this amount, here's the current amount of shares I've got, here's the current price of TQQQ, and it uses the signals that we have to basically tell you how much you should put into each one of them.
Wow.
And so anybody can do this. And the one that I'm using, Ed, is I'm using Claude. Let's see, Claude.
Yeah, I've been kind of watching as much as possible you interacting with Claude.
Yeah. And
This
so
is all very interesting. It's like a big flashback to early 2022.
Yeah,
with
it
AI
is,
with AI added in.
with AI editing. Yeah, it's just kind of cool. So what I'll do is try to collect all this data. Now, it would be good if AI would collect the data for me and do it. But here's one thing that I found out about the AI, Ed. You got to be careful because it makes mistakes. And so what I had to do is basically redo its numbers in a spreadsheet and say, and I held its speed accountable, and I said, wait a minute, my projections are coming up with this. Why are yours coming up with a different number? And then it apologizes to you and says, oh yeah, I'm sorry, I did the math wrong.
I was going to say, don't get AI pissed off at you.
Yeah, well, I think he's pissed off at me because I have found enough information. That's why I had to go in and build my own spreadsheet and basically say, hey, wait a minute, you're wrong, and do my own calculations. So if you guys are trusting AI to do anything for you, make sure you double check it. Now, I mean, it's good on things like this. Like yesterday, I told it what I was talking about in my video, and it gave me a video title to use in YouTube: Mastering Risk, a fully hedged TQQ strategy explained. So what we're doing, Ed, is we're basically going risk on into a TQQQ TMF type strategy, but we're doing it with the hedges.
Mm-hmm.
So we
Bobby,
still,
didn't you make Claude work for 3 days straight with no pay, no food? I mean,
yeah, I mean, I did. I put him to the test, and he was getting. It was actually Chat GPT that worked and was getting pissed off because I kept going to him. I said, "Are you not finished yet?" You know, and it said, "Oh, I'll be done by noon," and then noon would come, and it'd be like, "Oh, I'm sorry, it's taking longer than expected." And I think if I were to go back to Chat GPT, it's still working on the back test. It still has
I
not.
mean, it's a legitimate employee,
Yeah, it is.
not meeting deadlines. Like,
Yeah, it's
Sloughing
got an
off in
attitude.
general.
What's
Huh?
this? What's this, y'all? How could Alabama have beaten Vanderbilt in football? My
Oof.
God, how did they lose that game? All right, let's see what, I mean, Coach DeBoer needs to get on there. There's no record of Alabama losing a football game to Vanderbilt in recent history. It's only got stuff from April.
well, that's a good thing.
Yeah, it's a good thing that it doesn't know
We
about it.
just need to forget that that ever happened. It actually didn't happen.
The last time the two teams played was in 2022. Alabama won that game 55-3. Oh, that was the good old glory days, wasn't it?
I was there when they won 66-3 or something.
No pregnancy leave. That's right, Schwartz. No pregnancy leave. But I don't know. I just, I hate to say that I was soured on the option strategies, but I nearly jumped back into the 1-1-1-1-1-2, but I just can't with good. I mean, knowing that it wiped out a couple of years of my gains, I just can't jump back into it. I'm not.
Yeah, the only thing I see people using it, and I see people using it just like they were before. And you know me, Bobby, like in a low amount, it's probably okay. But when you're at 5, 7, 20, 30x notional, I mean, it's a ticking time bomb. And
Yeah, I just
Bobby?
don't. I just don't want to do it again. That's just me.
Can I jump in?
Yeah, absolutely.
Hey, it's been a while. So, hey, Ed,
Hey, Victor.
I just wanted to kind of comment a little bit on the strategy. I personally also I'm not doing any 1-1-2s or anything like that anymore. Just I realize it's just not good trade overall long term. So I switched to something else that is much more robust. But that's beside the point. I do like the TQQ. I'm also tempted to just put a little bit of money in TQQ and or DCA or something. But as far as your plan with the hedge, I just want to point out that I think as an idea it's good, but I think the hedging part is wrong for this particular strategy because you have a triple reacting daily QQQ here, which is very fast moving, and by the time your particular hedge, which is which is only doing good on a huge move, you're already way too down. I think you would need a more sensible, more faster reacting hedge for this, and then just maybe cash in more often on that hedge, and then just transfer money back to TQQ when it's cheap. So in other words, let's say you're running some type of a 14-day hedge, maybe 5 or 6, 7 delta, not 1 or 2 delta, but something that would actually react or faster, and then just cash it in when the market is down and the TQQ will be down, but then buy more with that money that you get from the hedge, because I think your hedge, the Black Swan hedge, will basically not even react when you 50% down on your TQQ.
So what do you think? We need something more like the put debit spread?
No. Just a plain naked put long, because you're making a lot of money on this one when the market is going up. So you can actually spend a little bit more on your hedge that you're gonna cash more often. Because on your hedge is just costing you money, and it's gonna perform good only when the market pulls down, in a black swan event or something. But I think that combined with the TQQ is a little bit different than that combined with a regular whatever other normal strategy you would have, because TQQ will react fast. So even if it's gonna go triple the daily move. So let's say the Qs go down 5%, you'll be down 15%. Another 5%, you'll be again a new 15% down from that point, and you're only 10% down overall on the TQQ, and might be even less on the SPY or the ES where your hedges are, right? So your hedges are not going to react most likely strongly to that. So what I'm saying is, if you instead had just a long put at 14 days at a higher delta that costs maybe $100 or something, then that one would react much faster. And when the
So you're
TQQ
saying
is,
just do one a week at 14 days and just every
and
week
maybe even just do it when the VIX is low,
Yeah.
don't even do it all the time. Or but I'm just throwing some ideas, because I think that the hedge and the underlying are mismatched in this scenario a little bit.
Okay.
But other than that, I like it. I mean, I like the TQQ overall. I think it's it's good.
Yeah, and that's a good thing for me to think about, and I will definitely think about that, Victor. I think that you bring up a good point, so definitely I'll think about that. All right, guys, great session today. Appreciate you all. Love you to pieces. Hope you have a wonderful day, and we will see everybody tomorrow.